Okay, welcome back. So we've talked about pivot points, cheats, load cheats, basically what to look for the setup. All right, what we're going to look for, and then how we're going to buy a stock through that buy point. We covered that quite a bit. Um, Here's something that is really one of the big questions, and something that took me a long time to learn because I spent so many years and so long trying to figure out how to buy that once I started getting that down and the stock went up or had some kind of problem, I didn't know what to do. I didn't even think about selling or taking profits in particular, or maybe if something went wrong and how it was acting abnormal to let me know that maybe I should sell it even before the stop is hit. I just didn't even really pay much attention to that because I was just thinking I got to find this right stock, find the next big stock, and buy it at the right point. But that trade needs to be managed. So what we're going to talk about now is what to do after you buy, and we're going to talk about what you do and don't want to see. So once you make a trade, you're gonna watch it and start gauging whether it's telling you, hey, this is acting right, or this is acting abnormal. This is acting normal or abnormal, which in case you would either stick with it or maybe even increase your position or reduce your position or maybe even sell it even before the stop gets hit. Now, some of this and some of these terminologies and some of these concepts go all the way back to Jesse Livermore, talking about natural reactions, what's natural and what's normal and abnormal. And then there also, and well, actually, I'm going to get to him in just a minute. Actually, let me go. We're on page 212. So I'm just going to jump for 1 second to this page. We're going to jump over one page and go to 214. So another gentleman that influenced me on some of this work and taught me something very valuable was a man by the name of Bill Berger. And most of you, I'm sure, won't know who Bill Berger is, but he was a fund manager. And back he ran the Berger 100, and he was beating all the other funds and doing really great. It was a small mid-cap fund. Dave, do you remember Bill Berger?
Oh yeah, yeah,
I think Bill Berger was an O'Neill client. I think they were an O'Neill client at the time,
yeah.
if I remember. And so I met Bill Berger at one time, and went up to him and I said, Bill, can I ask you a question? What, and this is why I ask everybody who's successful. I always ask them, what's the key to your success? What's the secrets? What can you tell me? Can you give me some advice? So I said, Bill, what's the secret to you? You're beating all these other funds and you're doing so great and you're running a large amount of money. He said, son, I buy tennis balls and I sell eggs, and walked away from me. And I was like, okay. And I didn't really even think much of it. I almost thought it was a joke and maybe he was just like fluffing me off. And then I realized he gave me a multi-million-dollar sentence. And I've been using that concept ever since for my entire career. And that one sentence has literally made me millions. So let me show you here what this means. And so when you buy a stock and it's coming out of these bases and coming through this pivot point, right? You've done your analysis, you're in the uptrend, you found the VCP, you identified the pivot point. David and I talked about that right side being really tight. We want to get it down to single digits. When it comes out of that buy point, you're going to buy just as it goes through there. You don't want to buy it more than 1 or 2% beyond that optimal buy point. So now you've got to start gauging the stock to see if the stock is acting normal or if it's acting abnormal. And what I call confirmations or violations. I'm looking for confirming signals to tell me that I should keep holding this stock even after maybe it makes a decent move. I might hold it for a much bigger move. Or if there's violations, now I start seeing this is not normal. The stock's not acting right. And that proverbial train is not coming in on schedule. I want to make sure that the train is coming in on schedule, and I'm going to gauge that based on whether the stock is acting normal or not. Now, so what is a natural reaction? A natural reaction is simply a pullback that after you break out, you pull back. Usually it's a number of days to weeks, and then you'll very quickly move right back into new high ground. That pullback will generally be on lighter volume than the breakout or the subsequent breakouts. And the key is that you want to see that tennis ball action. So we know it's a natural reaction, or I should say we don't know it's a natural reaction until we get the tennis ball action. The tennis ball action, you look for to take it back into new high ground, get back through the reaction high. So the reaction high is right here on this left side. It pulls back. Now, once it takes out that reaction high and gets back into new high ground, that's now deemed a natural reaction. Now stock rallies and it pulls back again, and now we're going to gauge it again and see, is this natural or is this abnormal? Okay, again, you see, boom, back into new high ground, tennis ball action. Bounces like a tennis ball. That's the concept. If you take an egg and you drop it on the ground, it goes splat. You take a tennis ball, you throw it on the ground, it bounces right back, right? So one of the things, and Dave, this is something that you've talked about many times, and that is when the stock comes back, it may take, 7, 8, 10 days, whatever, and then boom, it only takes a couple days to get right back into high ground. And that actually works the same on the downside. It would be the reverse if the stock was in trouble. Can you talk about that a little bit?
Yeah, it's when a stock is in an uptrend, it's got a definite pattern, a definite way that it moves, and it moves up quickly and then either goes sideways or drifts down. And then it moves up again quickly, and then sideways and drifts down, and that's what this stock here. And you can see it you can see on where the arrows are. The stock moves up very, very quickly, and then drifts down.
And back here, I moved up to Netflix.
Yeah.
Let's stay on Lululemon. Sorry about
that. And lots of times it doesn't give up much ground. It just goes basically sideways, and that's just telling you that there's just not much profit taking. There's not much selling. So, but then when you get to the top, the whole thing reverses. The moves are down very quickly, and then they drift up. They struggle to make any ground up, and then they get hit hard and they struggle. So it's just the opposite, the way the stock acts on the uptrend versus the downtrend.
Yeah, and you can almost count the days. You can see here where if you count these days, there might be, maybe 5, 10 days that you're coming back, and then 1, 2, 3 days, boom, you recover everything. Same thing here. You see, you got maybe a week or two, and then just in 3 or 4 days, you're taking off. So the rebound is very quick and very powerful. What that's telling you, and this is what we're always trying to gauge. We're trying to gauge whether you're getting institutional buying or retail buying. If you have retail buying, it's not going to move the stock very much. Sometimes you can break a stock out at a late stage in a bull market when everybody's been doing well and it starts to get real obvious. You'll have stocks break out of these bases, and then they will just go up for a day or two and then come back down. Institutions will sell right into it. Now you've got retail buying, institutional selling. What you want is institutional buying. You want to be putting your money side by side with when big institutions are moving that stock up. And then on the flip side, when the institutions are selling, of course, you want to be out. So this is the way we gauge that. And we're going to show you a handful of examples here and really start to fine tune or really start to zoom in. Remember, we talked about the satellite view, the aerial view, the overhead view, and then moving into the microscopic. We're really coming down now. We're starting to zoom in here and really start to look at some very specifics. So this is Netflix, right? We broke out of a nice base. This is one that I purchased coming out of this base here. You can see it just pulls back, and you've got a 5-day pull natural reaction. And then in 2 days, look at this. Pow. See how powerful? So when it does that, you probably don't want to sell on this bounce back here. That's telling you that stock's acting really well, especially if you're coming off of a bear market. And this is one of the first stocks to be breaking out of a base. You might be on a real key leader. And this stock made a huge move from here. Of course, we all know this is in 2009. Netflix made a gigantic move from this point. Just in a short period of time, it was up 500%. Now we move up again. We pull back, right, as we inevitably will after a good move. 7-day natural reaction, and then see 1, 2, 3, maybe 4 or 5 days, you're right back into new high ground. That's tennis ball action. And here's your recovery volume. Very strong on the recovery, big volume on the recovery. Let me show you another example. So here's Great Plains, and you'll see how similar that they look, right? And similar in time frame too. So you see here, you come back here for a couple of weeks, and then pretty quickly you're back into new high ground. And you get another natural reaction, and you're back in new high ground. And so now, as this is progressing here, you're sticking with the stock as long as it's acting right. Now, if it's acting abnormal, which we're going to show you in a little bit, you might reduce, or you might actually sell the position, or you at least would have a heads up and know that this is a stock that, may come in quick on me, and I've got to really be ready to cut my loss if it starts turning against me. I'd show you here. So here's Central Garden and Pet. So again, we break out here, couple days, right back to new high ground here, pull back. Now, you can also get, sometimes you'll form what we call a cap. And very often this will happen when the market is weak, or maybe you're in a correction and the stock breaks out, and then the market takes another leg down or gets weak in the interim, and maybe the stock came out early before. The leaders very often will come out before the market even makes its last leg down. And then when it makes that next leg down, it'll pull the stock back to the breakout, and it'll form a little mini pattern, which we call a cap. I call it a cap. A lot of this terminology you won't hear anywhere else, unless some of it now is taken off and it's all over the internet. But still, there's a lot of vernacular that I still use. That this is just terms that I came up with. The cap is simply a little mini. See, it's like a little mini DCP here, and you got a little cheat area, and then from there, and that they're usually about they usually take about 12 to 18 days to develop, and then from there you'll break out of there. And again, is this natural? Yes, right now this is very natural, and we come right back in tennis ball action. See the pullback here, just a couple days down, boom, we're right back in another pullback. Look how fast, right back up. So now eventually you're going to want to sell. You're not going to just wait forever. Natural reaction. When you get to when you get to your second or third rebound from a natural reaction, usually you're looking at another natural reaction that's going to actually be a little more excessive. And what will happen then is you'll start to undercut previous lows, and you might get shaken out of it at that point. So this is actually all these charting techniques and all these examples will be valid either if you're on a weekly or a daily pattern, right? We've been looking at dailies. Now we're looking at a weekly. But I just want to show you how we come out of this base, right? We move up, natural reaction, we move up, and you've got a handful of natural reactions. Remember, this is weekly now. So this is 1-2 weeks, 1 week here, another 1-2 weeks here, you're back in. And now you see you go to a bigger move and you undercut that previous low. And that's what a lot of people will get knocked out there, because they're thinking now it's going to roll over, and then wham, it comes right back. And again, you get another natural reaction and a recovery with tennis ball action. And here again, you see you move and you undercut the previous low, then you come back. So what my general rule of thumb is that once I go through the, usually 2 or 3 natural reactions, I start looking to sell into strength. And I don't want to wait for this, because I don't want to get shaken out. I might it starts to get more volatile once you get that move. Dave, you hold stocks, probably for at least, in recent times. I think you hold stocks longer than I do. I'm more of a trader. I know you do trade as well too. But what, when you go through where you're getting a number of natural reactions of stocks moving up, are you selling at what point are you selling into strength versus waiting for it to reverse and give back too much of the gain?
Well, when it's made a nice move on a percentage basis, I mean, so this stock that we're looking at it breaks out at 18 and makes a move to 28. That's really almost a 50% move that stock makes. And when I see something like that, if I like it longer term, if I think this is a stock that's going to make a move that's going to last longer than just a few months, but could go on for a year and a half or more, then I might trade down. I might trade the position down and just cut the position after it gets very extended, and then wait for the new base to form. But at least keep something in there so I keep a close eye on it. Because sometimes what can happen is you do take if you take everything out on strength, then 3 weeks later you're looking the other way, and then all of a sudden the stock takes off and gets extended, and you can't get aboard. So it depends. If I really like the fundamentals and the group that it's in, and there's a real theme of why it's moving.
So you might reduce,
yeah,
and still keep a small core, and then look to add it back as it starts to turn back up.
Exactly.
Right.
Exactly.
So now, one of the keys here that I want you to understand is that once you go through these couple of natural reactions, 2, 3, 4 natural reactions, What if you want to play it for a bigger move, you're most likely going to have to hold through some volatility, a larger pullback, and even an undercut of a previous low. So I just want you to be aware of that, that's where it will start to be unnatural, if you will. You're going to have wider moves, but they're just going to start to, the characteristics of them are, and the dynamics are going to be a little bit different. And you're going to start getting shakeouts and larger moves, larger bases, and there'll be more volatility. And the more the stock goes up, the more that's going to happen. You're going to get more and more volatility until you start really getting to where it comes under distribution. You get into a stage 3 top, and then you roll over into stage 4, and you should be long gone after that. Let me show you another example. So here's another one, and this is just what Dave just talked about a 50% move. This is coming out of this power play. I actually bought this stock coming out of this little base right here. It's a small base because it's a power play, AMAG, and it made a nice move in a short period of time. You're looking at maybe 1, 2, just a couple months, 2.5 months, you're up 50%. So you went through a handful of little natural reactions, you see, and now it gets more volatile, and you undercut this low. Then it comes ripping right back. Again, runs up. You see, you go through this and you undercut the low, and then it comes back. So playing for that bigger move is now going to require you going through wider move, wider volatility, and some undercuts of the low. I just want to make you aware of that, so you can understand the maturation. And we're gonna take this to where we get to the longer term top, and we'll start to show you what the bigger tops look like when you're getting to the stage 3 and then to stage 4. This is just looking at it from that that move up from the base. All right, so let's move on here. All right, so what are some of these bullish? So what are confirmations? What are bullish signals? When the stock breaks out, what do we want to see, right? So the first thing is we want to see follow through buying. It doesn't always happen. You may not get follow through buying, but we'd like to see follow through buying, especially if you're coming off of a big correction or a bear market. And these are some of the first stocks to go. They usually go, and you're going to see days of rally. Dave, why do we want to see multiple days of follow through? We want to see a stock break out and then follow through and have several days moving up.
Well, it's a sign of institutional buying, and the bigger the volume, the longer the number of days goes of where the stock is up and it's up on big volume, is just more signs of institutional buying, and that's what powers a stock higher. These moves where a stock doubles, triples, quadruples, it's not done just by retail buying, but it's the huge money that is behind the institutions that create these huge moves.
Yeah, now, and there's a few ways that we can look for these footprints in the snow, if you will, or tracks in the snow, to see if we're looking at institutional volume or if it's retail volume coming in. So one is follow through buying, see multiple days. Another one is to look at the days. Once you get 3, 4, 5 days, 7, 8 days under your belt, how many days are up versus how many days are down? How many of those days have good closes versus how many have bad closes? How many have volume on the upside versus volume on the downside? And you're going to look for, of course, that tennis ball action, that natural reaction. Is it coming back and it was spending more time pulling back and less time rallying? So let me show you how that looks. So here's Yelp. So you come out of the buy point here, few days, you come in here, that's completely natural. And then wham, look at these days, 1, 2, 3 days up, and look at the volume coming in. So that's definitely big volume coming in. You're talking about over 8 million shares here. It starts off with about 3 million shares, moves up to 5 change million, up to 8 or 9 million shares. So the volume's getting heavier, and then you have just a brief pullback and right tennis ball action right into new highs again. That's a very successful breakout. That's exactly what we want to see. And Dave, you said something. I remember when I read it many years ago, decades ago, of course, in Market Wizards, you said the best, and this has resonated with me ever since, the best thing a stock can do is be at a profit right away. And that's how I know that I'm probably going to make money on the trade. What did you mean by that?
Yeah, well, it's now you get you get a confirmation of your purchase within seconds. But it was usually in the old days, you would call a broker or call the trading room, and by the time they gave you your price of execution, you were already up on the stock. And it's almost the stocks that are hard to buy, where you try to get your position bought, your starting position, and it's actually moving so quickly it's almost hard to put on add-on buys. So it's those stocks that are up immediately on the day, within even the minutes that you buy it, are the ones that are probably going to be your biggest winners.
And did you find historically, looking back at your track record and your past, and just from anecdotal evidence, that's usually the case, that those are going to be the winners, and the stocks that just don't have any real power on the breakout and come back in, those if we were to bet on those two groups, the group that has the confirmations is going to probably do much better, right?
Right. Because I feel that I've gotten my timing down and I know exactly what to look for, that I'm expecting at the moment I buy that stock should be turning higher.
Okay. And that's where David just gave you the key. That was the golden nugget. See, it's about getting the timing down. This is how you know if you got your timing right. This is all about timing. People always ask me, do you time the market? I don't really time the market. I time stocks. Timing the market is very difficult. It can be done, but it is very difficult. It's very random, and the market itself as a whole is somewhat efficient. Stocks are not. Stocks are very inefficient, and you can time them quite beautifully. So that's what it's about, and it's about knowing whether that train is coming in on schedule. If you've timed it properly and you're waiting for the train to come in, and then to be proven that your timeline is correct. Now, again, here's another thing. Here's another little subtlety. So we're going to get into real subtleties now, right? These are things that you probably would never be looking for until you start to learn them, and then you'll see them. I mean, you'll immediately look at a chart and you'll know, yes, that looks good. Nope, that's not acting right. So if we look at the days here and we look over this 9-day rally, 7 of the 9 days are up. Right? So only 2 days down out of that time. And then look at here, 1, 2, 3, 4. We've got, I'd say 5 or 6 days are good closes in the upper half of the range. So more good closes than bad closes. So everything is really hitting on all the cylinders here. Let me show you another example. So, okay, so here you see, again, you break out 1, 2, 3, 4, 5 days. 4 out of those 5 days are up. Just this one day, 1, 2, 3, 4 good closes. So you got 4 good closes, 4 days out of 5 days up. That's excellent. That's great. So now we're out of the gate. We broke out. You might be tempted to take this profit. It's up, I don't know, $16, $17 up to $22. You have a nice little move there, right? Maybe you're up 15, 20%. So now the big $64,000 question is, do I sell? Do I hold? Well, again, you should probably go through that first pullback and see if you can get tennis ball action, because you had such a successful breakout. Now you get the tennis ball action, and now that means you should try to hold it and go through another pullback, or at least go for a bigger gain on it. So now again, you go through another pullback, more tennis ball action. And again, you just keep going through this process, engaging it. Now, here's the key. And this stock from this buy point went up almost 500% in 11 months. That's a huge move in a very short period of time. And that's the key about the timing, is when you get that timing right, you can get very big moves in very short periods of time. And that's the key. That's how I've compounded all these big returns. And that's how David won U.S. investing championships. And that's the way that you get the big returns, is to be able to compound, because time is money. We talked about that earlier. Now, okay, another thing I want to point out. We're on page 222, by the way, right now. Another thing is that to play these for a bigger move, again, you're going to have to go through some of this more volatile periods. But again, if you're short-term trading, you're swing trading, or even you're shorter-term trading, you may be selling into this first move, or you may be selling into the second move, and that's going to be your window. If you're playing for a larger move, well, then of course your risk reward ratios are going to be you're going to be different. You're going to have a larger average gain probably, and then you might change your parameters a bit. But this is still, no matter if you're going for a swing trade or if you're going for a bigger move, we're talking about what to look for from the breakout. Okay, once the stock comes out of here, and then it gets, and I don't know if you talked about this. I can't remember, Dave, if you talked about once the the launching pad, the rocket comes off the launching pad. Once it's out, now we don't have to look for that volume coming in and that 1-2 punch that I talked about and all that. We're just looking at the pullbacks and the natural reaction and whether we're getting the tennis ball action, and we're not looking at we're not having to have big volume on breakouts. It can still go up. It can even go up on lighter volume. All right. Why don't you just explain that?
Yeah, the most important volume you want to see is when the stock is coming out of a base. And as I said earlier, the bigger the volume, the better. But once the stock is out and running, you don't have to keep on that huge volume doesn't have to keep on coming. Yes, you want to still look at the volume, and you want to look for big volume spikes, especially if the stock has been moving for a long time, and then you get a huge volume spike to the downside where the stock is down and the volume is very, very big. That you want to take notice of it. But stocks can go for a long time on some very, very light volume, and the example I use, it's like a rocket coming off the launching pad. It blasts off and it needs a tremendous amount of fuel to get it going. But once it starts up and it's been going for a number of minutes, then it doesn't need as much fuel to keep it going or as much volume to keep it going. And then once it gets into orbit, then it takes a very little amount. Once it gets into its orbit, and it can go for a long time. And it's just sort of the same analogy that you can use with a stock taking off and a stock in a nice uptrend.
Here's a stock that I bought, Baby Stores, back in '98. Came out of a perfect base, nice tight pivot. You see nice big volume here. See these 4 days? 3 out of 4 days up, right? Now, look at the volume. 1, 2 on the 2 breakout days. Then the pullback, look how low. And then again, boom, big volume here. So now we come off that launching pad that David's talking about. Now we're up in the sky now, right? Okay, great. Now we're looking to see if the pullbacks can come back in and then get tennis ball action if they're natural reactions. Natural means it pulls back, maybe pulls back 4 or 5 days. Sometimes they pull back just a couple days, maybe 4 or 5, 6 days, and then just a couple days back into new high ground. Right here, you had a 1-day pullback, and then it came and it went moderately into new high ground, and then again, right here, back into new high ground. Another pullback, 6 days back, and now we form this little tiny little VCP. It's the exact same thing, almost looks like this pattern, only on a little mini basis, and we come out again. You get another natural reaction until finally, you're looking to start nailing down your profit into a decent move here. So we got one, we can call this 2, maybe 3, 3 or 4 natural reactions. Now, I'd be looking to probably sell if the stock really starts to run up here. We're going to get into sell rules. So I don't want to talk too much about selling just yet, but we're going to get into sell rules and we'll show you that too. But right now we're just talking about looking, is it natural? Is it a breakout that is confirming, or are we seeing violations? And we're going to get those violations in a minute. Let's keep looking at confirmed breakouts that are looking good and acting well, and then looking to see what we need to know if we're going to hold them for a bigger move. Look at this, 8 out of 10 days up. So this breaks out, goes up 8 out of 10 days, just a really strong breakout. You want to go through a natural reaction here and then see if you can make a bigger move, because the stock is just acting so well. It's such a great breakout. This is such an indication that institutions are piling in, and then with a very small pullback and a quick recovery, it's just total confirmation. So again, another natural reaction, boom, 1 day back into new high ground. A few more examples. Zillow. So Zillow comes off of this pivot, it's a little cheat area. Look at this, 7 out of 8 days up. Look at this natural reaction. It barely pulls back at all. That's how strong the stock was. And then bang, right into new high ground. Then you get another little pullback. 1, 2, 3 days. 4th day turns up. Just 1 day later, back into new high ground. And look how strong, right? Another little natural reaction, back into new high ground, little mini cheat area formed here. So it just keep going through this. Now, again, once I get to that, like I said, you get to a couple natural reactions, 3 or 4. Now I'm going to start looking for more volatility. I'm going to try just usually sell into the upside and try to get out before I get that volatility comes in. Okay, REX, another little cheat area right here, comes out 5 out of 6 days up. And you see how you drift in here, and then in one day, boom, back into new high ground. You had a squat on the close, but 2 days later, you recovered that too. Now you get a little more volatility, same thing. All right, let's take a look here I want to talk about, Dave. So when we get these breakouts, this is what you call your MVP indicator or an indication that the stock is really, really strong. You talked about this, I think, in Momentum Masters, and we always get a lot of interest in this concept. Google's a perfect example. Why don't you talk about this when a stock breaks out? You found that when it was, and maybe you can go back and talk about the history of this.
Yeah, this is something that I kind of spotted when I was running the New USA Mutual Fund, which was during the mid 1990s.
That was with O'Neill, right? That was with O'Neill.
Yeah, that's when O'Neill wanted to start a mutual fund to help support the newspaper. And what happened, what I started looking at is that we would buy a stock as it was coming through its buy point, but then when it got extended, then we would stop buying. But what I noticed is that some of these stocks just kept on going higher, and they did it on volume. And these turned out to be some of the biggest winners. But we stopped right at that, at that time, it was like we would stop buying at 10% from the pivot point. Now, now it's a lot closer where you were saying 5% or less. But the closer you can get to the buy point, the better. But anyway, we found in these big winners is that they had some very common factors. And from the time they started moving, their first up day, they were up 12 out of 15 days. And they were also up 20% or more in price. And during that 12 out of 15 days, they had at least a 25% increase in volume over a typical 15-day period. So above average daily volume, they had a big increase. So those were the characteristics found in stocks that just kind of kept on going versus stocks that made a 20% move and then pulled back. And these things kept on going higher. Yes, eventually they build bases, but they turned into be some of the stocks that moved for a year and a half or more.
And this, Dave, this turned out to be what is known now as the ants. The ants.
Well, yeah, the reason why we called it ants is because the programmer actually put little markings on the chart, little black dots where this started happening. And so they looked like...
I should have done that. I should have, out of all these years we talk about this, I should actually put those on and illustrate that. Maybe at another time we will do that. But so they called it the ants because you'd put all these there's these little hash marks that would show where the stock met that criteria, right?
Yeah, and this looks like it met it somewhere around where that first tennis ball action came in, right around in there. That would be 12 out of 15 days up from just the buy point would probably be about where it started. It would, if we had a color chart, you'd actually probably see it a little bit better. But it's just you want 12 out of 15 days. You want big volume, and you want the stock to be moving up 25% or more during that same period of time.
Let's be clear here, Dave. Sorry to interrupt, but let's be clear that we're not saying that once you get 12 out of 15 days up and it's on volume, that you're necessarily going to be buying there. The stock may be extended at that point and may be due for a pullback. But let's just say you bought it here at the breakout. And now we're up 7 days in a row. And then it meets this criteria where 12 out of 15 days it's up and there's a good increase in volume. Well, that's a stock that you may not want to sell. And you might want to hold for a much bigger move. Or if it can pull back and maybe rebase, take that stock very seriously on that next move up, or maybe you sell out of it and you take that short-term profit, but you're looking to buy it back on a pullback buy. So this is just an indication that the stock is really strong and that you may have a tiger by the tail. Would that be right,
yes,
Dave?
Yes. And you don't, in something like that, you really don't want to lose the position, because these are the ones that, again, as I said, you're looking the other way. You've got other stocks, and all of a sudden this thing just breaks out again, and you miss it, and then it takes off for even a bigger move. And it's just, you want to keep something in there, so you keep a close eye on it, or you just don't sell much of it when you get that indication that you've
that was
had
the case.
powerful buying.
This was Google. That was the
Yeah.
case. This was Google. Now, this also, this tennis ball action and counting the weeks up and so forth, and up days versus down days, good closes. This works on a weekly as well. This is all. It knows no time frame. So this is just a weekly chart of National Beverage, and you can see again breakout, natural reaction, tennis ball action, runs up, natural reaction, tennis ball action, same exact thing. It's not going to change. None of this is going to change. People, worry whether this is going to change, or if everybody takes Mark Mינארווני's seminar and listens to Mark and Dave, it's not going to work anymore. This the law of supply and demand. This is like gravity. It's not going to change. It's the same, and I assure you too, most people aren't disciplined enough to even stick to these rules and these strategies to begin with. So again, take a look at here. It's on a weekly. So you see the breakout on Netflix came out of here, and we looked at the daily. Remember, we saw those nice little bursts, and then the pullbacks, the natural reactions, and then tennis ball action. Well, we look at a weekly, 6 out of 7 weeks up, and then we pull back here, and then look how quickly it takes all these weeks to come back to the breakout point, and then look at the tennis ball action. Pow! 1 week, it erases all that. You see, that says. And I remember this was, I believe this was on earnings. I remember when the stock did this, and then it just drifted up, and I think this also might have met the MVP or ANTS criteria. Yeah. So now, here's the question: what do everything we just looked at? What do all these previous examples have in common? And this is what you want to look for that optimal stock, that stock that breaks out, and the stock that you want to hang on to and go for that big winner. Number one, they're profitable immediately. Remember, Dave said, the stocks that are up and he's at a profit immediately, those are the ones that generally turn out to be the bigger winners. Follow through buying. They all showed follow through buying. Right after the breakout, there was follow through buying. There was multiple days. More up days than down days, and more up weeks than down weeks, whether you're looking at a daily or a weekly chart. More good closes than bad closes. Closes in the upper half of the range versus the lower half of the range. Tennis ball action. They all had tennis ball action, right? They all came coming right back, and good volume characteristics where there was high volume on the rallies and low volume on the pullbacks. So now let's take a look on the opposite side, okay? The opposite side is your bearish signals, what I call violations, right? Bullish signals are confirmations, right? The breakout's being confirmed. Bearish signals are violations. Now, we're going to go through these. I'm going to show you some charts just like we showed just before. But I want to go through the list here. So low volume out, high volume in is the first one, right? This is when you break out. Now, you could break out on high volume, but if the volume comes right back in, the stock comes back in very quickly on higher volume, that's a red flag, right? That may not be a reason to sell, but it certainly should get your antennas up. Then you want to look to see if you've got a number of consecutive lower lows, not closes, lower lows. So 3 lower lows should get your attention. A 4th lower low should really get your attention. Now, especially if they're on volume. If they're on very low volume, it's pulling back pretty naturally. It could be okay. But as you're making the lower lows, especially if they're on volume, you want to start looking for supportive action around the 3rd or 4th lower low. The reason is because institutions, this is all about understanding the footprints and the buying patterns of institutions. Institutions they'll buy a stock. And Dave, I'm going to want you to talk about this. So they'll buy a stock, and because they've got such big volume to move, they'll run the stock up, and there might be a number of institutions in there, but even one institution can run a stock up. So as they start running up, they back off. They don't want to defeat their purpose, right? So they back off. Now, as the stock comes back, usually a couple days, 1, 2, 3 days, they go back in there and they start buying again because they told their trade desk, they told their traders, we need to get a 1,000,000 share position in this, get us in at a 45-degree angle here. And so on the pullbacks, they don't want the stock to get away from them. They want a position. So every little pullback, they go back in there and add to it. And that's what creates this pattern. Right, Dave?
Yeah. Yeah. It's because, think about it. It's, as Mark said, institutions aren't buying 1,000 shares and then they're happy they've got their position. They're buying millions of shares, and it takes more than a couple of days, especially in some medium-sized cap companies. It takes them 3 weeks to get their position, and that's where you see the big buying show up. But if it does get extended, they'll back off. They'll wait till it comes back in again a little bit, and then they'll keep on buying until they finish their position. But it takes a lot more time, and that's what you're looking for. You're looking for their footprints in the market as a stock's moving out.
Right. And if that stock's coming in and it's coming in for day after day after day and big volume on the downside, well, then that's telling you that there's not a lot of institutional support there. And it might have been retail buying, and now you may even have institutional selling if the volume's picking up. So after 3 or 4 days, we're going to show you examples of this in just a second. I know right now you're having to use your imagination a bit. So more down days than up days, just the reverse of what we talked about before. More bad closes than good closes, just the reverse, right? Now, the other thing is I don't use moving averages almost ever for a crossover. There's only a couple instances, which you're going to learn about all those today or through this workshop. One is, though, immediately after the breakout. Again, once the stock's up and it takes off, it's not as important. But right after the breakout, the 20-day line becomes important and the 50-day becomes even more important. And what we found was when a stock breaks out of a base, if it comes and it comes back in and it closes below the 20-day, the probability of it working cuts in half. It's half the probability. If it had a 50% probability, it's got a 25% probability now. And if it goes below the 50, the probability goes down even more. So we want to see it hold those two lines. Sometimes the 50-day will be lower than even your stop will be, and you don't have to worry about that. But certainly if it goes below those and it closes below them, it's another red flag. Now, wide and volatile price action. All right, that's another thing we're going to show you in just a second. But now the key is that it's not like one of these is going to say, hey, we're going to sell the stock. No, you're just going to start watching and seeing if the violations are piling up. You start getting 2-3 violations all piling up around the same time, then yes, you probably want to start reducing, or if they're really critical, really serious violations, you'll even sell the stock. Let me show you what these look like now. Okay, let's start off with low volume out, high volume in, low volume breakout, high volume back in, and a close below the 20 and 50-day. So this was a late stage base in Lumber Liquidators. Lumber Liquidators was holding up really well when the market corrected. It took off. It made a really big move. And then it came off of this, which, amateurs would see this and probably buy this as a base, maybe a cup with a handle here, look at it and call it a VCP. It's pretty sloppy, and it's not the greatest pattern or greatest price action, but it does break out of here. But then what the key is, you see it comes out, and the volume's not even that great to begin with. But then just a couple days later, see, there's no follow through. The next day it's down, then it's down again. Then it gets this little feeble 2-day rally, and then wham, gets crushed. And look at the volume, and it gets below both the 20 and the 50-day. So if you hadn't hit your stop yet, let's just say, your stop was at 8%, and this is down 6% here. I'd be out. I'd definitely get out of here. This is totally abnormal. This is not how a stock should look after it breaks out. Let's show another example.
Yeah, I was going to add, and then you can see it. The same thing on this it's the 1-day breakouts. I hate the 1-day breakouts. I mean, if it only goes up 1 day and then it starts reversing, that's a major flag, because what that is just a lot of retail buyers seeing a stock. It's been consolidating. It's got a decent base. It breaks out. And in fact, that it only goes 1 day is just telling you is probably just retail buying. There were no institutions adding on or buying new positions, and it starts reversing, and that's a telltale sign right there.
Yeah, and it doesn't mean you don't necessarily sell. You see one day breakout, next day it's down. That's not a sell signal, but it certainly is it should raise your antennas, and you should start watching it carefully because it needs to put on its running shoes pretty quickly. You want to see it get right back into new high ground and see that if the volume didn't come in on the breakout or you didn't get the follow through days, you want to see them in subsequent days and not too long. You're trying to get your timing perfect here and within a number of days. So if this stock doesn't get going, within a week or two, you probably mistimed it pretty severely. So let's take a look at another one here. Here's it's simple as OUTR. This is an older company, Outer Wall. Not even sure if this is listed still. You get a nice little gap here, drifts back here. Okay, breakout right here, right? So this gets a 1 day, 2 days. It actually moves up the next day, but has not a great close. But then you see it comes right in, and then the volume comes in on that next day. You see the volume is much higher, much higher. Now, again, we're going to start looking and counting. This is 2 lower lows. So we didn't get the 3 lower lows yet, but now we're sitting there right by that. I believe this is the 50-day, right? Yeah, this is the 50-day. We're sitting right at the 50-day line. 2 days later, boom, we're below the 50-day line now. So this is really just showing very abnormal action. I would have been out of this right away, probably right on this day right here anyway. I want to point out too, again, I said this before, but I want to say it again, that most of the stocks that we're showing you, not all of them, but most of them, the grand majority of them, I was trading at these times that I was buying these breakouts. And I didn't have hindsight. There was no hindsight. These aren't where we went and picked charts that made our point. We said, oh, yeah, this one looks good. Yeah, some of them we've studied some leaders and studied some stocks and pulled out some models. But the grand majority of these, 95% of them are stocks that I've actually traded.
Yeah, Mark, one thing I just wanted to point out on this chart too is when that stock gapped from 64 to 72, you have to ask the question, even there, why didn't it follow through? Because if it's such a great stock and it must have been some earnings news or something to get it going, why didn't it keep continuing or even after 3 or 4 days take off and go? But it sat there for, it looks like 3 or 4 weeks and tried to move. So interesting sign that you might have seen could possibly fail if it didn't follow through the first time.
Right. And this right here, what David's saying is that as you drift back here, and we talked about, coming back for a number of days and then erasing it very quickly, this looks okay. This looks, pretty good. It's coming back pretty quickly. And, it didn't follow through here, but it drifted back. And now you're saying, okay, tennis ball action here looks good. But now it doesn't confirm. It doesn't confirm. And David's saying over here too, this just wasn't. You'll see some of these stocks, they'll break out on earnings and just keep running and running, and that's where we see something like the MVP move, where you get the 12 out of 15 days, and now yes, it may be extended, and you're not going to buy it there, but it showed that previous power. It's showing that there's a big appetite for it. What David's saying here is there's no real appetite for this stock, and then even here when we thought there was some appetite, nope, it came right in. Let's look at some more. Okay, so here's another one where we get the breakout here, and then you see it doesn't follow through much, and it just immediately stalls out. Now you get 3 lower lows, 1, 2, 3. At that point, I want to see some support. I don't like that it closed right near the low, this big down day, and it closed below the 20-day line. So now we've got some violations here. We didn't get any follow through, right? We didn't get follow through buying. We've got 3 lower lows. We got bad closes. Every close is bad. It's below the 20-day line. This is really looking ominous at this point. And then look at the next day, wham, right? Now it just comes in, it's right off. You can tell how, it just didn't act right. And right there, it's telling you either reduce or run for the hills. All right, another one, all right, TRTN. Really nice little pivot here. And again, sometimes these are going to look beautiful. Just because you get it down and you can spot a VCP and you get this great pivot point and it's got all the characteristics, it doesn't mean it's necessarily going to work. And Dave, we should talk about how, let me ask you a question, Dave. In all your years, you've been doing this longer than me. I don't know how many years now you've been doing it, but certainly over 40. What percentage of stocks are your gainers versus your losers? How often are you actually right?
Well, if I'm right half the time, I think I'm doing a great job because I play a lot of stocks, I invest in a lot of stocks, but if it's half of these don't work out, I take very, very small losses. But if I can have two or three really just take off and go and have a huge move, and I buy them correctly and I add to them correctly, those two or three big winners makes up for all the very, very small losses.
Yeah, and sometimes the stock looks perfect, but you know what? The market's just bad. And you actually get the analysis right, but the market is just in a tough time, might be going into a correction, and stocks are even giving you heads up that you're heading into a correction. The market really looks fine if you're looking at the Dow and you're looking at the S&P and the Nasdaq, but the stocks aren't acting right. And then later on, the market rolls over and the stocks were sort of the canary in the coal mine. So here, again, I want to show you some examples where where you can get lured in, where it looks good, but very quickly it doesn't look good. And I always say, always be prepared for the opposite side of the trade. So when you are long, you need to be prepared to move very quickly and move to cash. When you're in cash, you need to be prepared to move very quickly into getting some exposure on, because things change very fast in the market. You can go from 1 minute there's no stocks to buy, and then there's a whole ton of them. In 1 minute everything's acting great and you're all happy and giddy and making tons of money, and the next thing, whammo, you're giving half of it back and you're underwater before you even realize it. So again, here we break out, right? You get a little follow through day here, right? You get another day, but then look, the big volume comes in. Look at this big bar. So you've got the volatility, much bigger bar to the downside, right? And now you've retraced a full retracement of that move, high volume in. So you got low volume out, high volume in, and low volume out, high volume in doesn't mean that it's a low volume breakout. It means that the volume on the downside is larger than the breakout volume. And now you're getting some lower lows. You get 1, 2, 4 lower lows. So you're getting below the moving averages now. You're below the 20 and the 50. If you had not hit your stop yet, I would be out of this regardless. My stop was maybe a little lower than this, I would still be out. I wouldn't even wait for my stop at this point. And you see here, then it just goes stone cold dead, can't rally. And then the real selling starts coming in because it's under distribution. Institutions are selling. And now you really start to get the damage. Let me show you another one. So here you go again, where you break out. This was OLED. Come out of this little base here. Nice little pivot, squat, reversal recovery, little pullback back into new high ground. This is looking not too bad. Okay, we got out of the gate and we're holding up pretty good. 1, 2, 3, 4, 5, maybe 6 out of 8 days or so up. Not too bad, looking pretty good. But then we get 1, 2, 3, third day down, pulling back to the breakout. Fourth day, now we're below the 20, the 50, full retracement, high volume in. No, this is we're getting violations now. Now you got to start reducing. You got to start looking, or at least have your heads up to get ready to sell as soon as it hits your stop. Another one here. Now, here we break out of this base, which already wasn't a very good base. It's kind of sloppy to begin with. But we come out here and we get a decent breakout, big breakout here, a couple small follow-through days. Now, this pullback right here, this is not something that's abnormal yet. Even with the 4 lower lows, this is okay because it's quiet. You're pulling back naturally to the breakout point. And if this turned up and came back into new high ground, that would be great. I would deem that as a natural reaction. But look what happens. It tries to turn up and then boom, it comes in. High volume in. See, it's a failed natural reaction. And it closes now below the 20-day and it can't rally. See how it just wedges itself up? And now the selling starts coming in. This little circle right here is where you definitely want to be out. If you weren't out here, this is a 100% you get out at, regardless of where your stop is. A little dead cat bounce here. And look, now the big selling comes in. Now you get the real damage comes in. That's what you're trying to avoid. When you start getting these violations, it could mean that you've got some real distribution coming, and the heavy selling hasn't even started yet.
Yeah, the thing to point out, I think that, and you mentioned it, is on that high volume day down. It was down that day, and then three total days in a row were down. But then it looks like it looks like about 12 to 15 days where
3 or 4 weeks.
it couldn't even retrace what it lost in 3 days. It tried for 15 days to get going. And the fact that it couldn't retrace that was telling you that this thing had no power at all and was something that was probably ready to really roll over.
And Dave, if we flip this over, we would get exactly what we were talking about on the upside, on the downside, right? We got where here you pull back all these days, right?
Yeah.
Or you rally, if you want to call it. You rally all these days, and then just in a couple days, boom, you're in new lows.
Yep.
So exactly on the opposite, where we look for the pullbacks, they come for maybe a couple weeks, and then just in a few days it erases it all. This is the same thing, only in reverse on the downside. Most of what we show you is going to just be the opposite on the upside to the downside. These rules. That's what makes them, really, really easy to follow. Is that once you get good at them, you just look at them from either side. So here's another breakout. This was in Michael Kors. Came out of this little pivot right here, this cheat area, and immediately had trouble. It tried to tighten up and what I call a reset, and tried to turn up again and immediately failed there. And this is where I really said, oh boy, this could be getting into big trouble here, because this is just totally abnormal now. It tried to come out here and then it tightened up a bit more and had another failure. Now this is what I call a ledge, where you just go straight sideways. After you break down, you go straight sideways and you can't rally. And just like we just showed you before, you see how it takes a number of days, I don't know, 5, 10, maybe 15 days to barely rally back at all, just like Dave said. And then just in a couple days, boom, it's right into new lows again. We actually put this on our short list right here. This was one of our recommendations on the short list as it broke through the 200-day here and was breaking down from this ledge. So it went from a potential buy over here with just not long later, within a number of weeks, we're looking at shorting this. And this stock imploded from there. It had a big decline from there. I'll show you another one here. So again, you see you break out here. Here's the pivot point. You get the 1, 2. Okay, great. Everything's okay at this point, right? All right, now you get a couple reversals and you're not getting much follow through day. If you count the days, you got, 1, 2 days up, 2 down, 3 down. So if you got down days outweighing up days, you get a little feeble rally. And now you get 3 lower lows below the 20, below the 50. See, everything's piling up on you. Right? All these violations are piling up. That's where the red flag starts coming up, when you start seeing a number of violations. And again, your stop might have already been hit at this point, but in this case, probably not, because this is just coming right near the break-even point. So this really probably wasn't at a very big loss. Then you put in the ledge, so you can't rally much, and then back into new lows. Let me see if we have any other examples here. Well, this one right here, you get a gap on earnings. Then you get a nice little pivot right here. It breaks out, but then you get 8 lower lows here, right? And it retraces everything, comes all the way back down here. And now again, just like before, you see it takes a number of days, and just in 2 days, boom, exact opposite of what we want to see on the upside. Now, another thing is looking, whenever you buy a stock in a base, you always want to look to the left. The left is where it's like looking for traffic crossing a street, but think of it on a street that's one way, right? Everything's coming from the left. You're on a one-way street, because that's where your supply is. And being able to be cognizant of what type of supply is to the left of you, it really will keep you out of a lot of trouble, or keep you away from troubled situations. Because again, Dave, you always say, just draw a line across where the majority of the price action is. This is a perfect example where this stock, really is just constantly had trouble. It tried to break out here, had trouble, came back up, and just keep trying to base here. But this level right here really becomes a formidable opponent, right? And you just can't get through it. So when I see that, what I want to see happen is I want to see the stock get near that level, tighten up and quiet down, because that means this supply on the left side has stopped coming to market.
Yeah.
Remember we talked about the towel getting squeezed and the water coming out of it? That hasn't happened yet. There's still a lot of water in this towel, and that's why it can't rally, because there's a lot of selling. There's a lot of supply. There's a lot of stock for sale, and it does just the opposite. It breaks down and it forms this little pivot to the downside. It forms a little mini ledge and then breaks down again. So again, looking to the left and looking for price action to the left.
Yeah, it reversed. I mean, you can see 1, 2, 3, almost 4 reversals right there in that 48 to 50 zone. And it reversed and it closed on the low almost every single time.
Yep.
I've actually I came up with another term the other day. I think it might stick. It looks like a porcupine. It's got these quills that are sticking up.
Yeah.
And boy, you can get stung, or you can get hurt badly if those quills go into you. And this is exactly what happened.
Porcupine supply.
It's a porcupine pattern.
Yeah. There's, and again, you'll notice that each time I show, one of these charts, that Dave will come up and come up with this nuance. I'll come up with a nuance and I'll say, okay, take a look at this, and I'll go deep into the pattern, start looking at specific days, and then Dave will go in even deeper and find these little nuances. See, this is the type of eye that you're gonna develop over time, but you've got to do this in real time. We're doing it and we're showing you here on charts in hindsight, but you've got to learn to do this in real time. We do this in real time because we've been doing it for so many years. You'll get there too, but it's going to take some time. That's why you have to do post-analysis and go back and look at your trades and see if you're seeing this stuff. If in real time you're making these plays correctly, and then you'll see what you did wrong, what you did right, and you'll start to see those common denominators. So like I said, always be prepared for the opposite side of the trade. This is why. You see this stock breaks out here, you get the natural reaction, and then it fails. And you get the 3 lower lows, the stock can't rally, and this stock ended up going down 99% in just 3 months. That's the risk that's in the market. Look at the huge volume that comes back in here, right? That's where, not necessarily you can call it a low volume out, high volume in. It does come after the natural reaction, but this is a complete tennis ball action failure. It tries to break back up, and then just comes right back in, and you start getting the violations. You get the big volume in, you get the 3 lower lows, you get the close below the 20, now the 50-day. Like, you can't rally. If you did not hit your stop yet, you would want to be reducing this or even selling this even before.
Yeah, and then the other thing too is look at the 2 days that stock moved out from. I guess it went through 19 and 20. Farther. Yeah, right there is look at the closes on those 2 days when it should be breaking out and closing near the high or the upper half of the range of those days. Those look like 2 stalling days. Yes, they were up, but they traded higher and closed in the lower half of the pattern, and just kind of telling you that didn't have enough fuel, enough power to get it going.
Yeah, you're not really getting that real strong tennis ball bounce.
Right.
So what do all these examples now have in common? What are all these failures? The breakouts that were successful and had the confirmations, every one of them had certain things that were all in common. All these failures have certain things that are all in common too. One is lack of follow through. More down days than bad days, and more bad closes than good closes. Up days. Very poor volume dynamics, where you've got on the upside, instead of having the strong volume on the upside, you've got the weaker volume on the upside and the stronger volume on the downside. Reversals, where or what Dave just called the porcupine look, where we have all those reversals and that supply, and then closes below the 20, the 50-day line soon after the breakout, and no tennis ball action or very weak tennis ball action. In some of these cases, we saw just the opposite. The tennis ball action, if you will, it was like we flipped the chart upside down, and it was having tennis ball action, but it was to the downside, right? So again, just looking for these violations and these confirmations are going to start to have you understand when a stock is acting normal, when it's not, when it's under accumulation and when it's under distribution, and when there's institutional money in there versus retail, or maybe to be able to spot the retail breakouts and the institutional selling into those breakouts. All right. So I know I'm moving a little fast here, but we got a lot to cover. Now, some of these stocks will break out. This is starting to get a little more advanced now. We're going to get into some more advanced techniques here, and things that are going to take even more skill and more time to cultivate your eye and your skill for these. But what will happen is sometimes you'll get what we call a reset, a failure reset. There's two kinds of resets. There's a pivot reset and a base reset. We're going to first look at the pivot reset. So the pivot reset is when you set up a base. And one of the reasons why this stock in particular is, I would say near and dear to me, but it's a nightmare, because I was in this. I bought this perfectly, and then I got knocked out of it, and then it reset and just blasted off to the moon. I'll show you right here. So here's where I bought it. I got knocked out right over here, not right over here, but I got knocked out over here. And then my mistake wasn't getting knocked out. I stuck to my plan. I got stopped out, but then it tightened up. It got really, really tight. It reset, and boom, look at the breakout here. And it wasn't the greatest second day breakout, but you got the tennis ball action. It's acting pretty darn good. And this stock went up 90% in 26 days. So I was in it. I got knocked out, and my mistake was not getting back in on the reset. So you want to look sometimes, once you, and again, Dave, we talked about this before, where when we sell a stock, we don't necessarily just throw it away. We keep it on a list. I keep a list of all the stocks I sold, and I still watch them for a number of days, even weeks after. You do the same, right, Dave? Yeah,
because sometimes it might be a market correction that keeps the stock from continuing higher. It could be a number of things, but especially if a stock has the great fundamentals and a great setup, but is just not ready, then you could come back to it weeks later or even months later.
Let me show you another failure reset. So here's another pivot failure reset where you form this pivot. And sometimes the pivots are in hindsight, you look and you go, that wasn't the best pivot. I was maybe stretching a bit there. It was a little sloppy. In this case here, you get the breakout, but then you get a close and way at the low, and you get a big reversal. And then the next day, boom, it comes in, takes out the low in the pivot. And this is pretty ominous action, but it comes right back and it retightens up, and then it breaks out from here. So a lot of people would get knocked out of this, and they would never even think about coming back into it because they were just hosed on it. So watch very carefully, because what will happen is a lot of times you'll have something that appears to be a decent pivot, but then it shakes you out, and then it resets, and the pattern actually improves. The VCP, it just took more time to form and to get that water out of the towel. So just all this is telling you is right here, there was still water in the towel. You need to get that water out of the towel. Once it was all the supply was wrung out, now the stock can break out and go freely. 254% in 7 months. See, that's a great move. See, that's the kind of velocity that's going to really give you, even if you got a piece of that, if you got 1/3 of that, a quarter of that, you got yourself a nice move in a very short period of time. Here's the same stock, okay? And this is what we just saw right here. Here's the breakout, squat, reset, recovery. Now, it's set up again. Once it broke out, it made a little move. It actually went through a big base. Now, in this instance, I'd be knocked out of this stock here, all right? You'd probably be knocked out too. Over here, it tries to break out, it squats, and it comes in the next day, but there's no violations there. Yes, it's not acting great, and we did not getting follow-through buying is not a violation. It's just not getting confirmation. Okay, so we didn't get the confirmation here, but a couple days it tightens up and just forms that pivot, holds the lows, and then boom, breaks out, and you get that recovery. And then look how nice and strong, right? So again, you might have come in it right here. You might have come into the stock right here as it started to move, and it didn't break out. This is not a sell signal here. These aren't violations. The thing I want to make sure you understand is that you go into a stock with a plan. and you've already determined what your risk is going to be. So you say, okay, I'm going to risk 5%, or I'm going to risk $1,000, and this is the price that I'm going to stop out on. The key is to wait until the stock proves you right or wrong. So you want to stick with that stop unless you see the violations start to pile up, and you really, and even in the beginning, you're going to need to be more mechanical at this. Dave, somebody who's just starting, I mean, we're really going advanced here, right? I mean, would you suggest that, maybe they just stick with the stop and not get too cute with, sort of, selling if they see a couple of violations? This is going to take time to get this type of discerning eye, right?
Yeah, and it's going to take a long time, and probably a lot of losses too to get to the right look, and to know exactly what that pattern should look like. I also suggest, if people are just starting out, to use a portion of the money they have allocated for stocks, because you're bound to make a lot of mistakes. And so maybe take 50% or 25% of your money and trade with that, invest with that, and put the others to the side until you really get this down and you start having some success.
Yeah, we're going to give you, pretty, 95, 98% of everything through this workshop. We're really laying it all on the table, but we're also laying on the table, a combined of, I don't know, 90 years worth of experience. So this is very advanced. As much as we're breaking it down here and showing you all these examples and really quantifying it, to do it in real time, this is really advanced stuff. So you've got to start off with the basics and first learn how to make sure you're staying in those uptrends and locate those bases and buy through that pivot point. And then you're going to start, getting more of a discerning eye and have experience and understand what's normal, what's abnormal. We're giving you reference points, tools, things to watch for red flags and things to watch for green lights. But it's going to take a lot of experience to apply this in real time.
Yeah, and Mark, one last thing going along with that is that you said, we give you just about everything you need, but the last key is to study your own losses, your own successes, because that's where it's all going to come together when you start seeing the patterns of where you're making mistakes. And if you can start cutting down on those mistakes, then your success will go up dramatically.
Right. And we're going to actually specifically show you how we do post-analysis, and we're going to go through some very unique ways of doing post-analysis and tell you exactly how to conduct that post-analysis and what to look for when you're looking at your results and your trades. I want to show you just a few more here, because these resets could manifest themselves in a lot of peculiar ways. But we're always looking for that tightness. We're always looking for that tightness on the right side. So you can see right here, we had a breakout attempt, and it was just wedging up the right side, kind of sloppy. And then it fails. It comes in for a number of days, and this would have knocked most people who are, using tight stops and are risk adverse, would have probably knocked them out and got shaken out here. But then look, it really tightens up, and this reset, the stock looks so much better now. I mean, it really looks nice and tight. But you might have been over here trying the stock over here, and maybe you got a little sloppy there, and things were working, the market was taking off, so you bought it, you got knocked out, and now it improves. And now you see how nice the breakout is now. Now when it finally, the water gets out of the towel and you really get that tightness, and it's set up properly, now you get 1, 2, 3, 4, 5, 6, looks like 8 good closes, almost every day up, but maybe, or one. I mean, really just a nice, efficient move, very little pullbacks. You get some tennis ball action right away. And again, you see how many days it takes here, and then wham, right back into new high ground. That's what you want to see. Here's another reset, chef. So you break out here, and again, you roll over, and now you reset a whole nother base. And this is just, sometimes again, you'll have where stock breaks out and the market rolls over. You have a correction in the market, and it causes the stock to come back in and maybe stop you out, undercut the low in the base, but then it resets. Or you might be in a a bear market, a correction already, and you've taken a leg down, the stock breaks out, and then the market takes another leg down. And maybe sometimes the last legs are the real doozies, and that's where you get the real acceleration in selling. And a stock that tried to break out in maybe the first one or two up legs, now when you get that exacerbation in selling, it just comes right in and then needs to reset. Now you get the reset and see again, look at when it's really ready. Look how efficient. Boom, 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 boom. Look at one. What do we got here? 1, 2, 3, 4, 5, 6, 7, 8, 9 days, right? Nine days up here, 12 out of 13 days up total in this rally. And that's really super strong, super strong. This was Dick's Sporting Goods, and I traded this stock right here coming out of this pattern right here. You actually had a nice little base here. So now this is really important because if this stock had broken out here and moved above this high and this pivot, I would have bought it right there. Now, maybe I would have been stopped out. I don't know, or maybe it would have worked, but it didn't. It set up and then it failed. Then they had guidance was upped, and it had this gap on upside guidance. But now it doesn't have VCP characteristics, right? I had to wait. So there was some good news, if you will. And then now it went through and it tightened up. Now it got look how nice and tight here. Now you've really got that nice big base. You've got the shakeout. It shook out the low. You've got the demand coming right back up the right side. And you've got the tightening, and you've wrung out all that water out of the towel. The stock is ready to go. And this stock went up huge from here. It was a great, great winner. This was a stock that, Dave, you probably remember Elan back in the 1990, coming off the lows, going to the 1991 bull market. Here's a perfect example of what I was just talking about. You try to break out here and you go into new high ground. The market had actually topped right here. And from here to here was a bear market. So now, as you break out here, the market actually already came off, but was having a rally, a reaction rally, and then it sold off again into the final low, which was right here. The market bottomed right here. The Dow was down 25%. So that took the stock back down, and that made this base fail, which was a pretty crappy looking base to begin with. So this was faulty to begin with. But somebody might have fallen for this. I saw this stock as it came up the right side right here. See how nice it comes up real strong, and then it tightens up, and then look how tight it is right here on the right side. And that's the great. Look at the volume. Volume comes way down, and then boom, off to the races. And this is where we were going to war over in the Middle East. And on the announcement of war, the market broke out, and a bunch of stocks that were set up came ripping out of these bases. And you had just a nice launch out of off the launching pad there.
And see how many months that you had to wait. So let's say you bought it and it broke out and it failed on you and you sold it. Well, that's where you then put it into a watch list and you keep an eye on it every week. You look to see if it sets up. So, and look how long it took. It took from September until January for the whole thing to set up again. But then you had a great move after it came out of there. But that's where if something didn't work, just don't forget about it and say, I hate this stock. Sometimes you have to buy it twice or three times before it really makes that big move.
Yeah. In this case of Dick's, you had this setup here and it failed. And now you had the guidance, right? Sometimes you'll even have an earnings report and it'll run the stock back up. And the fundamentals, if the fundamentals are good and the stock's acting well, then your job is to wait for that optimal buy point. All right. The key is you want to make sure that the stock is what I call price ready. You could have the right stock, but not at the right time. And you want the right stock and the right time. That's the key, is to wait until the stock is price ready. Right here, it's price ready. Over here, okay, fundamentals may be coming in, and yes, it's got a lot going for it, but it hasn't gotten to that point where you're timing it where you're trying to be at that immediate profit. Okay, Baidu, another one, V-shaped base. All right, came up here, sloppy right side. This was totally looking failure prone from the beginning. then comes off here, has to reset, and now you're getting that nice right side build. And then you get the cheat area. Now you get the little handle here, and you get multiple buy points. Again, a failure turned into a nice base. These could actually, I've been studying these resets for so long that I've got so many different ways that I play them now. Some are even, kind of bizarre. I call them expert buys. When you get to some of these that I wouldn't necessarily recommend that you do, certainly in the beginning. But here's one that was with Spirit Airlines. I think, Dave, you and I were looking at this at the time. We were talking about this. It came out of this base. It came back in, and then it tightened up right here. And this was really, trading what I call very close to the danger point. After it came down like this and put in this little pivot, this low is really key, because if it just starts selling off from here, it's just all going to hell. So this really was just game time. It needed to either to go or punt, and it just came ripping out here. You got 5 days up, 10 out of 11 days up. Great breakout, but this was a reset. It originally came out here, then it came in, got below the 50. This would have almost certainly stopped you out, but then you see it tightens up and you get a little reset and you've got a little low cheat setting up. That's why those low cheats, the cheats, they're so valuable, because you can apply them to reset. You can apply them in so many ways. And by having the low cheat, the cheat, and the handle, and even the pullback to the breakout after the breakout, you've got basically four floors that the elevator can stop on before it makes a trip to the 10th floor or the 20th floor or the 50th floor. You're trying to get in on floor maybe 2, 3, or 4, and then take a trip to a higher floor. You're not trying to buy in the basement or the first floor. So these give you, multiple chances to be able to get on a stock as it's coming out of a base. Here's another one where, again, you tighten up here, try to come out of this low cheat, have a quick shakeout, and then re-tighten. You see, there's so many, maybe you might even start noticing some, new ways, some new angles to play this after you've been doing this for a while. But there's a lot of ways that it can reset. The main thing is that you want the same characteristics. You want the VCP characteristics. You want that tightness on the right side. Having a shakeout below the low is perfectly normal, but all the same rules are going to apply. The only difference is that, it came out of a pivot prior and it failed. So we talked about what I guess I didn't clarify, and I should probably go back a little bit, is that when I originally started, I said we're going to talk about pivot failures and base failures. So I showed you the pivot failures, and I also showed you the base failures. I just didn't pinpoint it, that when we take out the low in the base that was previous setting up, that's a full base reset. So if you just take out the low in the pivot and then you reset, taking out the low in the pivot might take a lot less time, or will almost always take less time to reset than if you take out the low in the base, because now you've got more work to do. It's just like, if you were to have an injury, if you sprained your ankle, it would take you a number of days maybe to get back running or get back on the tennis court. But if you break your leg, it's going to take a lot more. So a pivot failure is like a sprained ankle. A base failure is a broken leg. And if you go into stage 4, you're in compound fracture, broken leg, broken femur, you're in really bad shape. It's going to take a long time to recover. So again, pivot failure versus base failure. Dave, we're going to wrap this up here today. Any closing comments here? We talked about pivot failures, base failures and pivot failures. We talked about the confirmations, the violations. We went through a lot of examples of these things. Any recap?
I would just say that, a lot of these stocks had very, very good fundamentals. And when they fail the breakout and they have to reset, then just don't give up on them, especially if they have great earnings. Keep them on a watch list, because there are many times where you're going to go, oh, I lost money in that stock, I can't buy it again. But you just have to have an open mind. Just say, hey, look, my timing was wrong, or the market was wrong. And if it resets all over again, then you've got a brand new situation, and that's where you can get the real big move.
Yeah, I've had a number of big winners that I got stopped out 2-3 times in a row, and then I played it that third or fourth time, and it was a charm. And I just try to keep those losses, as small as possible, so I can come back. But yeah, what I do is when I'm stopped out of a name, I actually put it in a list I have of my sold stocks, and I look at those every day. I just keep watching them to see what happened, subsequent to me getting stopped. And a lot of times I got the name right. I was just a little early, and then it resets, or maybe it goes through, it actually improves because the fundamentals, they're not going to change in one day unless maybe, today's the earnings report and there's a huge miss. But the fundamentals are, if they're in place, maybe it's just not the right time because of the market, or the stock just needs more time to, to consolidate. So I keep that list. All right, so we're going to wrap it up, and then we'll come back, and there's so much more to go over, but we are wrapping it up for the day, and we'll see you during the next session. Okay, thanks.
Thank you.
Thanks, Dave.